Welcome to Your Wealth Matters. I'm Maria Dawes, and I'm joined by my fellow portfolio manager on the private wealth team, Janet Kinsing. Hi, Janet. Today, we're going to deconstruct the TFSA. It's a government program started well over 10 years ago now, and while it's been in existence for a while, there are some important subtleties worth covering off. So let's begin today by talking about what TFSAs are best used for, the withdrawal rules, TFSAs versus RSPs, and some common misunderstandings or mistakes that we've seen. So Janet, do you want to start us off with a primer?
Thank you, Maria, and sure thing. So the TFSA stands for Tax-Free Savings Account, and as the name implies, it's tax-free, meaning that whatever contributions are going into the TFSA will grow free of tax. And speaking of contributions, this number can and has changed in the past. Back in 2009, when the program was first unveiled, the annual TFSA dollar limit was 5,000. And at its peak back in 2015, it was 10,000. For the past 4 years now, the annual contribution amounts have been sitting at 6,000 per year. So that means if you were at least 18 years old in 2009, your cumulative TFSA contribution room is 81,500, which is pretty significant. Also, just a reminder that this amount is per person, not per couple or family. So that is even more significant when it comes to your ability to save taxes on your investment income.
Yeah, that's right. And I also want to point out that what you hold in the TFSA is key here too. So because these accounts grow tax-free, ideally you want to hold the most tax-prohibitive investments in your TFSA. For example, those with a diversified portfolio may have high interest earning investments. And a good example here is the Capstone Mortgage Pool, which generates taxable interest income, or investments that primarily generate growth through capital gains, such as a stock portfolio. Because interest is more highly taxed than capital gains, and capital gains can often also be deferred, it would be better to hold a high interest earning investment in your TFSA. But please, if you are holding stocks or mutual funds outside of your TFSA, and you're putting something like a GIC or cash in the TFSA, just reconsider that. Use your TFSA to efficiently shelter your taxable investment income as best as possible. We call this your tax location strategy, and it does require some forethought and a little bit of planning. All right, Janet, so let's talk about withdrawals. An area of confusion for some people is that they think if they withdraw from a TFSA that they have to pay tax on it, or at least on part of it. Is this true?
No, your TFSA is really a tax-free investment account. So that includes withdrawals. You never have to pay tax on these, but there is a catch, and it's an important one. Once you withdraw from your TFSA, you cannot put that money back in until January of the following calendar year. And please pay close attention to this rule because it's where most people aren't clear. This means that if you make a withdrawal for 6,000 in September of this year, you would have to wait until January of the new year to recontribute that 6,000. And then at that time, you can recontribute the amount withdrawn plus whatever the new contribution room is for that year. Okay, so we've mentioned a couple times already that TFSA withdrawals are not taxable, and this is a big difference from the RSP, which many people are familiar with. But Maria, what else do we need to know?
Yeah, another difference between a TFSA and an RSP account is that contributions to a TFSA are not tax deductible against your income. With this in mind, most people have to make the annual decision of, do I save to my TFSA or should I be saving to an RSP? Your decision should really be based on whether you could use that tax deduction off your income. If the primary goal is to reduce income tax in that year, then the RSP should take precedence. However, if you're in a situation where you're earning less income and may in fact potentially need the funds in a shorter period of time in the short term, excluding, of course, the usage of the home buyers plan and or the lifelong learning plan, which of course is another topic for another day. But the TFSA could be the way to go for shorter term funds. Okay, Janet, last topic, and this is a big one. What are some common misunderstandings and mistakes with TFSAs?
Yes, so keep in mind that a person can have multiple TFSAs, but this can be a pitfall. And we saw this a lot in the early days. People held multiple TFSAs, sometimes not even realizing that they had multiple TFSA accounts, and then found themselves penalized for over contributing. Another mistake is withdrawing money from your TFSA to either consolidate your accounts in one place or to move your TFSA somewhere else. Don't withdraw your TFSA to do this. Transfer your TFSA instead, and the new financial institution will help you with this.
Right. And I think it's also important to remember that your financial institution does not have access to the accounts that you have somewhere else. So ultimately, the responsibility actually lies with you to know what contributions have been made, where, and when. Even though CRA does house the information on your total TFSA contributions, that information could be incomplete depending on the timing of the contributions that you've made and the timing of the financial institution who have to submit that information to CRA. So one of our clients actually recently told us that CRA recommends to them to wait until May or June before determining the final annual TFSA contribution amount for that year, because it can actually take that long before their records are up to date from the previous year.
Yeah, CRA isn't always that efficient when it comes to helping us save taxes, unfortunately. And I'm sorry to say that penalties due to over contributing are pretty hefty. In fact, 1% of the balance over your maximum contribution limit for every month that you're over. These penalties obviously really do add up. My advice to help you out here is to keep your TFSA as simple as possible. Have one account, make your annual contribution, and have a long-term strategy that does not require you to withdraw on a regular basis. If you do withdraw, keep careful track not redeposit until the following year. Keep it simple, or else you could literally have to pay the price for it.
That's right. So here's a quick recap. TFSAs don't get taxed, but they have contribution limits you need to pay attention to. Because withdrawals cannot be recontributed until the next year, our recommendation is to keep these to a minimum and have a long-term objective for this account. Penalties are high, so make every effort to avoid them. Be responsible to track your own TFSA activity to avoid mistakes. Shelter your tax prohibitive investments in your TFSA, not your cash. If you're moving institutions, make sure you transfer your account instead of withdrawing it. And if you're relying on CRA's records to tell you how much room you have to contribute in your TFSA, wait until late in the spring or early in the summer to ensure that all of their records have been updated.
Thanks, Maria. TFSA is certainly a great vehicle that has significant positive implications in terms of tax savings. But remember, it also has its drawbacks if you're not careful. If you have any further questions about the TFSA, please feel free to reach out to your portfolio manager. We hope you've enjoyed this edition of Your Wealth Matters, and we'll look forward to seeing you next month. Bye for now.
Bye.